Welcome to Module 5, the Balance Sheet. I am Donna Gady, a farm business and production management instructor at Western Technical College near La Crosse, Wisconsin. One of the main parts of my job is to work with farmers to determine what their financial picture looks like and to track that picture to see if it is heading in the right direction. The first thing we always do is to complete a balance sheet. The balance sheet may be the most basic of all the financial worksheets, but to me it is the most important. Without it, none of the other information would mean anything. So what is a balance sheet? Simply put, it is a snapshot of a business's assets and liabilities which can be compared to each other to determine the net worth or owner equity. It is crucial to remember that a balance sheet is a snapshot of a farm's financial picture at a specific point in time. One balance sheet does not show how much money a farm makes over a period of time. It is like looking at one picture of a family member. We can see how cute the baby is and how big she is, but we can't see how fast she is growing or how she has changed unless we compare the first picture to one taken a year later. We can now see not only the difference in size, but also a little bit of the change in attitude about being put into a pumpkin. There are three main sections to a balance sheet. First is what you own or is due to you. These are the assets. This can be your real estate, machinery, or livestock or money that is owed to you. Your assets include things you own but still owe money on. Everything gets listed. The second part is liabilities. This is what you owe. Loans and bills to be paid. If you subtract the liabilities from the assets, you get the net worth or owner's equity. Hopefully, this is a positive number. Many times, farmers have questions about if they should use market value or cost value on a balance sheet. My answer is yes. There is usually a time or a place for both of them, so why not both? When we put an asset on a balance sheet, we have to assign a value to it. The market value is what the asset is worth if we sell it. The cost value is the original purchase cost minus depreciation. So let's look at a tractor. This tractor was for sale online for $40,000. If it actually sells for that, that would be its market value. But for the farmer that is selling it, the cost value is different. If he bought it 5 years ago for $45,000 and subtracted 10% from the value each year for depreciation, the tractor now has a cost value of approximately $29,000. A specific percentage of depreciation each year, like 10% on machinery and 15% on titled vehicles, is a good way to accurately record depreciation. This is different from the way many tax preparers calculate it. They usually fully depreciate a piece of equipment in the first few years. This is great for not having to pay income tax, but isn't very accurate. Plus, if you have a loan on a piece of equipment that is worth $0 on your balance sheet, your financial picture does not look very good. It is important to check the values on your balance sheet every year. Has the market value changed for a piece of equipment or your livestock? The one thing we do not adjust is the value of land. This is the primary reason why it is important to separate the buildings and improvements from the land on a balance sheet. The buildings depreciate, but the land does not. Here is an example of a balance sheet generated by the FinPack software I use that shows an equipment list that has both cost and market values on it. We work to get more detail every year so we can eventually have everything listed individually instead of having a bulk equipment line like at the top. On this farm, we list everything purchased for over $500 as equipment. If the pig feeder would be purchased today, it would not go on the balance sheet, but as an expense on a different financial statement. We will get to that in a different module. Let's get back to the balance sheet. Remember, assets minus liabilities equals the net worth. We usually start with assets when completing a balance sheet. Assets are broken into 3 categories based on their useful life. Current assets are defined as cash, things that can be easily converted to cash, or anything that is used up within a year on a farm. Here is an example of another FinPAC file of the categories for current assets. If you look on the worksheet that goes along with this training, you will see several of the sections marked current assets. I suggest you make notes on the worksheets as we go along so you can easily complete them when you get ready to do your own worksheet. The first line is cash and checking. It is important on your balance sheet that you separate personal information from farm information. This is especially important if your farm is a corporation or an LLC. So why is it so important to separate personal and farm? Well, in order to claim a tax deduction, you have to prove it is used exclusively in the business, so you need to keep accurate records. Also, if you're sued or seeking bankruptcy protection, some assets can be protected if they are recorded properly. Also, when calculating profitability, it increases accuracy if you separate personal from farm finances. Back once again to our balance sheet. First, cash and checking. These are from our farm accounts. It is important to put an accurate balance in here. If you have written out several checks that have not cleared the bank, you want to subtract those amounts so they are counted towards the correct time period. The next line is expenses and supplies. This is one area where I see many people forget items. Have you prepaid for fertilizer that is stored off the farm? Did you just get your fuel tank filled? Do you have a pallet of cow minerals sitting in the barn? What about corn seed left over or silage bags? As we move down the list, growing crops can be a bit confusing. The recommended date to do an annual balance sheet is January 1st or December 31st. At this point in time, you may have planted a fall crop that will not be harvested until spring or even later. When this happens, you have an expense but not an income from this crop. The growing crops asset is valued on the direct cost we have had to plant the crop up until the date of the balance sheet. Accounts receivable is any money that is owed you. If you did custom work for a neighbor that has not been paid yet, that is an accounts receivable. If your cows got sold at the sale barn on December 31st, but you will not receive the money until after January 1, that is accounts receivable. In this case, however, it is important to also take those calves off your balance sheet. For hedging accounts, just record your equity in the account. Another important asset to include on your balance sheet under current assets is crop inventories. It is important when recording these you are consistent. List all inventories. Always list them in the same way and put realistic prices on them. For instance, some of the farmers list feed on a dry matter basis and adjust the price to be based on dry matter. This helps them make sure they have enough inventory to last the entire year. If you look on your worksheets, you will notice feed in 2 different places, feed storage and feed inventory. Feed storage is just a list to keep in mind of where you store feed, the dimensions, and the crop that's in there. Feed inventory is the more specific place. The feed type, the volume, and the value. Both these places help you remember what feed you have on hand just so you can compare it to next year's value. And finally, on current assets, we have livestock held for sale. Usually everything but your breeding animals. You'll notice on your worksheets there's only one location for livestock inventory. You can put everything here and then divide it up on your balance sheet. Your type of animal, the age, the size, the quantity, date purchased, and purchase price are all on the inventory, as well as if they're home raised or purchased, which is what the HR/P is. On this FinPAC example, we have a livestock, the type of animal, a little bit of a description. You can put where you have them or what age they are, the number of head, our average weight, a value, and then we had our total asset value. The next major category for assets is intermediate assets. Think of these as items that are usually kept for between 1 and 10 years, and selling them would have a dramatic effect on the normal income streams for the farm. This is where cost and market values really come into play. You can see from the FinPec example, breeding livestock, machinery and equipment, and titled vehicles fall under this category. On this farm, the stock in the local cooperative was also recorded into intermediate assets. Consistency is important. Make sure you keep accurate records of where you put things and even why, so it can be repeated every year. Again, on our worksheets, intermediate assets of livestock were recorded in a previous example. For this example, we will use machinery inventory as an intermediate asset. Make sure you complete the list, and then each year all you have to do is update what was sold or disposed of and what was purchased. So, things to remember to record are the item, the model year, date purchased, percent ownership, the original cost, and the market value. Percent ownership is usually 100%, but some farms own machinery with another farm. Make sure you put the percent you own in this category. And finally, in assets, we have long-term assets, our land and buildings and improvements. Again, it is important to separate land from buildings and improvements because land will not be depreciated. What do I mean by improvements? It is usually construction projects around the farm that improve the value of the farm. A new roof on a barn, fences, water lines, all improve the property. Let's move to the other side of the balance sheet and talk about liabilities. As with assets, we start with current liabilities. This includes those items that will need to be paid within a year. Do not include monthly bills that are not past due. Those go on our income statement, which we will talk about in the next module. The first item we list is usually any accounts payable. This can be an account that is not paid off each month for feed or seed or anything that's past due. Keeping accurate records will help you split these accounts payable into categories like feed and seed so you can calculate an accurate income statement later. Also under current liabilities are current loans. Current loans are any loans that should be paid off every year, like an operating loan or a farm credit card. When times are hard, these may get rolled over into the next year, but our goal should always be to pay them off as soon as possible because these are usually our highest interest rates. If you look at your worksheet, there's a category at the bottom of one page that says Outstanding Bills and Accounts Payable, Current Liability. It's simply a list of what do you owe, what was it for, and how much. The intermediate liability category contains loans that are for 1 to 10 years. To be clear, the original loan is for 1 to 10 years, not loans that are for 15 years, but you have already paid on them for 5 or more. We do not move loans from one category to another. They stay where they started. Intermediate loans are usually loans for livestock or machinery. Our final liability category is long-term loans. These are usually our real estate loans or land contracts. On your worksheets, you will notice 2 pages that are for loans. It states your lender, your loan number, your item financed. These bits of information are important when keeping track of which loan is which. The interest rate and the date started are also important, as well as the payment plan, the date your payment is made, and your current principal or balance. Make sure you're recording these loans and update them when you refinance. Sometimes it is also important to check those interest rates. Make sure they haven't changed from year to year. Now that everything has been completed on the balance sheet, let's move to understanding what the balance sheet can tell us and to clear up some questions people usually have. Many people ask, okay, I have a lease on this piece of equipment. How do I record it on the balance sheet? It is only recorded on the balance sheet if one of the following is true. The ownership of the asset is transferred to the leasee at the end of the lease term, if you automatically get that piece of equipment once the lease is over. The other thing is if the lease contains a bargain purchase option. You're paying for it at pennies on the dollar of what it's worth. That's another reason to record it on the balance sheet. You can also record it if the term of the lease is at least 75% the length of the useful life of the asset, or if the present value of the minimum lease payments equals or exceeds 90% of the fair market value of the asset. You can see not all leases will go on your balance sheet. From that point on, moving from year to year on the balance sheet, amortize the liability and depreciate the asset value of the lease, usually over the useful life of the equipment. Remember, asset valuation is based on the lease investment, not the piece of equipment's final price. Now that we have the total assets and total liabilities completed, it is time to calculate the net worth. In order to calculate the net worth, we simply add up all of the assets to get total assets, add up all the liabilities to get total liabilities, subtract liabilities from assets, and get the total net worth. Here is part of a balance sheet generated in FinPack that shows the net worth. The total assets for the farm are $446,890 on a cost basis and $578,266 on a market value basis. Note the difference between the cost versus market value. The total farm liabilities are $190,318, and by subtracting liabilities from assets, the net worth of the farm is $386,623. This balance sheet also shows the owner's personal assets and liabilities as well as the difference between cost and market value, which is listed as the market value equity. So what else can we learn from a balance sheet? Working capital tells us if the farm has enough cash on hand to cover all the debt that is due. Working capital is calculated simply by taking current assets minus current liabilities. It is an important number when we're looking at financial risk management. It is reduced by cash capital purchases and family withdrawals, but it is something that many bankers and lenders will look at for a farm before they make those loan decisions. The current ratio is current assets divided by current liabilities. This includes the ability to pay family living, taxes, and debt payments. It really is a measurement of the ability to generate cash to meet the farm business obligations. So what else can we learn? We also will look at a balance sheet to look at the current position of the farm. What else can we learn from a balance sheet? We can check the farm's current position. We could also look at the balance sheet structure. Where is the equity? Are the assets matched with the liabilities? There really is no right or wrong answer, although many lenders have a preference for what they want to see on the balance sheet. We can also find the total solvency of the farm. Can this farm pay all of its debts if the farm is sold, or will they have to bring money to the table? The other thing is we look back and remember those two pictures that we had at the very beginning of the module. This is how we see net worth change. We compare one year to the next to see if the farm is moving in the right direction. Now that we've learned what goes into a balance sheet, I'm going to quickly go through the categories on the worksheets that go along with this module. The first one on there on the first page is your checking and savings account information. Make sure you're putting your account name as well as the bank that it's with so you can remember which one it is from year to year. Also mark whether it's a farm or a personal account. Remember, it is much better to keep these separate. And then you can simply write down a balance. Moving on, we have your prepaid expenses. This is again where I see many people forget items. Make sure you put the item, how much of it that you have, and the value. So for instance, if you just filled the fuel tank right before the end of the year, you're going to put diesel fuel, how much is in the tank now, and how much you paid for each gallon of fuel. Remember those supplies in the barn as well, like baling twine and net wrap and all of the things, seed, mineral, those kind of things are the things that people usually leave out, but they've paid for them and they have a value. Moving on is outstanding invoices and accounts receivable. These are invoices that people owe you. So if you sold some cabs that someone hasn't paid for, or if you did some custom work, that's where this goes. Make sure you are recording this. The next category is outstanding bills. These are not your day-to-day bills like the electric bill. These are ones that have been carrying over or past due, and accounts payable. So for instance, if your neighbor did some custom work for you and you have not paid him yet, that would be something that would go on accounts payable. Who do you owe, what is it for, and how much is it for? Moving on is your machinery inventory. This is one you can keep from year to year and just put what is sold or gotten rid of or what you purchased and then update. Sometimes you're going to want to update that market value if it changes significantly. The item, the model year, the date purchased, percent ownership, the original cost, and the market value should all be recorded. The next category is feed storage. This is really just a reminder of what you have. So type of storage could be a silage bag. It could be a pallet in the barn. Just remembering what is in your feed storage, upright silos, those kind of things. Type of storage. The dimensions are helpful because that's how we calculate how much is in it. And then, of course, write down what is in it. What crop is stored in that feed storage. Moving on, the next thing is a little bit more specific on your feed inventory. We're talking about specific types of feed, whether it's dry hay, whether it's haylage, corn silage. We may even have multiple different hay cuttings because they may be different nutritional analysis. You can change things and you can have more than one type. I see many farms that have multiple hay storage options and places, and they each have a different nutritional value. Make sure you write down the feed type, the volume, and the value for those feed inventories. The next thing is growing crops, those things that are still in the ground. We usually estimate those at the cost that it took us to get them to where they are, whether it's seed or fertilizer, if you had a custom bill to get them in the ground. Those are the things that we list on the growing crops category. The crop, the number of acres, and the estimated cost to get it to this point. Next is titled vehicles. The item, the model year, the date purchased, the percent ownership if you don't fully own it yourself, the original cost, and the market value. Moving on is our livestock inventory. It is important to remember which ones are breeding stock and which ones are there holding to sell them. Type of animal, the age, the size, the quantity, whether they were home raised or purchased, the date purchased, and the purchase price. Then we go to our largest asset, which is our real estate and property owned. It's important to make sure, again, separate those buildings and improvements from the land value. The description, total acres, original purchase price, market value per acre, and total market value. And last but not least on most farms are those loans. Make sure you're keeping up-to-date information on those loans. I have seen loans that the interest rate has changed from year to year and people don't catch it. Write down which lender it is, the loan number, item finance, the interest rate, the date you started it, the payment plan, day payment made, and the current principal balance. It never hurts to write down your lender's name as well. Many of our financial institutions have multiple lenders, and if you move from lender to lender, it's important to remember who started your loan so that person has the most accurate information most of the time. So those are the things to keep in mind when you're keeping records and to keep in mind when you're doing your balance sheet. So where can you go for more resources? First and foremost, your lender can help you do a balance sheet. Most of our lenders will spend a little time with you to make sure that balance sheet is up to date and accurate. The other person is your accountant. They should have your machinery list. They may not have the same values because we talked about depreciation, but make sure your accountant has an up-to-date list for you as well. Many states has a university extension system. You can contact your local agent for resources, or there may be a university resource. So in the state of Wisconsin, we have the Farm Center, which does a lot of financial work with farmers, especially farmers that are high risk or in high need of help from them. The other thing is a lot of states have a farm business and production management program. That is actually who I work with. So my contact information is on the screen. If you are interested or need help finding the closest resource in your state, feel free to contact me and I would be glad to help you. This is the conclusion of the Fearless Farm Finances Balance Sheet module. For more webinars, please visit the website on your screen.